When you buy an insurance policy, what you're really buying is a promise. It's a promise that the money will be there to cover you, whether it's for something that happens next week or decades from now. But how does an entire industry keep that promise when it's managing trillions of dollars of our money? Okay, let's get into it.
First off, you've got to understand the scale we're talking about here. The U.S. insurance industry is managing a pool of assets worth over $8.5 trillion. That's trillion with a T. That's bigger than the economy of most countries on Earth. So this isn't just some big number, right? This is the financial bedrock for millions of people and businesses. The stakes could not be higher.
And that really brings us to the core puzzle. This isn't about chasing fast, risky profits. No way. It's about making sure this enormous pile of money is safe, secure, and can grow just enough to meet all those future promises, no matter what kind of chaos the economy decides to cook up. So how on earth do they pull it off?
Look, keeping a promise for 50 years is hard enough, but keeping it while you're trying to navigate the ups and downs of the global economy, that's a whole different ballgame. It's this constant, delicate balancing act, like walking a high wire between risk and responsibility.
The analysts over at Wellington Management have this great way of describing the path forward. They say it's incredibly narrow. So think about it like this. Yeah, there are some reasons to be optimistic, but the room for error is just razor thin. One wrong step, one unexpected gust of wind, and the whole thing gets thrown off balance. We're not talking about a wide open highway here. It's a tightrope stretched over a very, very uncertain landscape.
So this is the push and pull they're dealing with every single day. On one side, you have the headwinds trying to knock them off course, things like stubborn inflation that just won't go away, a labor market that's starting to look a little shaky, and of course, growing geopolitical risk. But on the other side, you've got some tailwinds giving them a little boost, like fiscal stimulus and companies that have pretty clean, strong balance sheets. The entire game is navigating these opposing forces.
So you're faced with all this complexity, all this uncertainty. What do? Well, insurers don't just wing it. They rely on a really comprehensive master plan that's designed to bring every single moving part of their business into one cohesive investment strategy. And that plan is called Strategic Asset Allocation, or SAA for short. Now, the absolutely crucial thing to get here is that this is not just about picking winning stocks. As Conning's research points out, it's an enterprise-wide framework. What does that mean? It means before they even think about making a return, they're thinking about the promises they've made. Every dollar they invest has to be perfectly aligned with the claims they'll have to pay out in the future, their specific liabilities, and their overall appetite for risk.
And this diagram just illustrates that point perfectly. You can really see what holistic means in practice. You've got all these inputs feeding into this one central brain. You have the cash flowing in from the assets on one side, but on the other, you have all the constraints, the super complex accounting rules, the regulations they have to follow. SAA is the engine that processes all of this stuff at the same time. It's not some investment team working alone in a silo. It's the entire company's brain working together to make sure they're stable for the long haul.
So, to put it as simply as possible, for an insurer, the investment portfolio is not the star of the show. It's the support system. Its entire job is to make sure the main operation, the promises, the payments, the people, stays stable and secure for decades.
All right, so you've got this master plan in place. The next big question is, well, how do you actually execute it? What are the specific tools and investments insurers are using to find that stable growth, especially in a market like the one we're in today?
And folks, this is the trillion-dollar question, isn't it? When stocks seem pretty expensive and the extra reward you get for taking on the risk of corporate bonds, what the pros call the credit spread, is super thin, where in the world can you find stable, predictable income? This is where a category called core alternatives comes into play. Now, as JP Morgan Asset Management explains, these aren't your typical high-risk venture capital type alternatives. Nope, these are picked for very specific insurer-friendly reasons. A huge part of their return comes from predictable cash income. You can forecast their cash flows pretty accurately. And most importantly, they don't always move up and down with the stock and bond markets, which gives them some really vital diversification. So, what does that actually look like? Well, this table gives us some fantastic examples. We're talking about things like transportation leasing, the steady income you get from long-term contracts on airplanes and container ships. Or infrastructure equity. Think toll roads, utilities, assets that just generate predictable cash year in and year out. The common thread here is that these assets provide strong, stable income streams. They're perfect for matching up with an insurer's long-term promises. And listen, this isn't some niche strategy. The experts at Wellington are pointing to very similar areas. They're highlighting things like securitized credit,
which is basically just pools of loans, like mortgages or car loans, all bundled together, and also high-quality private debt. That's loans made directly to companies outside of the public markets. The theme is totally consistent. Find assets with protected, predictable cash flows. Okay, so having the right strategy and picking the right kinds of assets is a great start. But as any expert will tell you, the success or failure of a plan usually comes down to just one thing: execution.
And this is a massive challenge. I mean, the world of private markets is huge, it's complicated, and it's not very transparent. You can't just log into your brokerage account and click a button to buy core infrastructure. You have to decide exactly where, what, and how you're going to invest.
The CAIA Association has this really great choice tree analogy for how this works. First, you start really broad. Let's say you want to invest in private equity. Then you have to get more specific. You narrow your focus to, say, mid-market buyout deals happening in the Eurozone. And then finally, you have to pick your vehicle. Are you going to invest directly into funds, buy into existing funds on the secondary market, or use a fund of funds? Every single decision refines the strategy and shapes what that final portfolio looks like.
And when it comes to actually making those decisions, there are basically two main philosophies. In one approach, the board or the investment committee keeps a really tight grip on everything, defining very specific targets for each little subcategory. That gives you a ton of control, but it can also be pretty rigid. The other path is to set the high-level targets, but then give the investment team on the ground the freedom and agility to hunt for the best opportunities within those big categories.
At the end of the day, there's no single right answer here. The most important thing is for each company to find the balance that works for them, one that gives them enough control to stick to the master plan, but also allows for enough flexibility to jump on opportunities when they pop up.
So when you pull all of these pieces together, the economic tightrope, the holistic master plan, those alternate assets, and the super careful execution, you start to see a picture. And it's not a picture of speculation. It's something much, much deeper.
I mean, that just says it all, doesn't it? The entire investment philosophy is built for one thing: endurance. It's not about hitting a home run in one particular year. It's about making sure you are always in the game, always ready to make good on your promises.
Every single decision, from that high-level strategic asset allocation all the way down to picking one specific infrastructure project, it's all designed to build a fortress of stability. It is all about creating a portfolio that is so resilient that it can guarantee with the highest possible certainty that a promise made today will be kept 50 years from now.